Okay, we're going to model a property called Momentum House that is in Cambridge in the United Kingdom. So this case, we've actually already loaded some listing details. So I'm going to click on it in our property menu here. And you can see you have the listing details over here on the side, but there's been no other information added in. Rather than doing the quick start, we're going to use the model tab here, and we're just going to go starting from schedules, go all the way to the bottom and entering in the different sections. So let's get started here. So for inflation schedules, we have 3 inflation schedules. The first one is operating costs, and that is 2.75% per year. We have market rent, and that is 3.75%. And we have construction inflation, and that is 3.5%. And all 3 inflation types are linked to the analysis start and the analysis end, and they're per year. So everything looks good. We're going to hit Save Changes. And since we're not doing a quick start and we're going through the model sections, this save note pops up every time we save changes. And this is so we can keep track of what changes we made and other members of our team can see what we've done. So just put a little note here that we're kind of uploading. Let's put financial info for Momentum House. And we'll commit the changes. Okay, next up is leasing rules. So we only have one leasing rule here, and it's the office leasing rule. It's a traditional lease, and the leasing rule is that it typically will take, or we expect it to take, 6 months to get a new lease in place, and that lease will start on the 1st of the next month. The lease duration will be 5 years, and once it expires, it will go to market. The base rent is an amount per square foot per year, so we're going to change that to option here, and it works out to 62.5 pounds per square foot per year. And we're going to link that to market rent inflation. The step rent is a percentage of base per year, and that is 3%. And we expect these forecasted tenants that come in to, they're going to pay, or they're going to get a few months of free rent. They will get 4 months of free rent, but they'll be expected to pay their recoveries during that free rent period. Leasing commissions are done as a percentage of total lease value, and that is 6%. And we expect that we're going to have to do a contribution to tenant improvements of $30 per square foot. And we're going to link that to construction inflation. No incentives, and our forecasted leases are going to be full net leases. And we expect these tenants will pay their rent monthly on the 1st of each month. All right, we'll save the changes. Again, the save note pops up. Commit change. Okay, next up is spaces and uses. You can see here that we actually have a total of gross leasable space here for the property. And as we add spaces, ReturnSuite will keep a running tally of the total amount of gross leasable space, and we'll see this increase. And just so you know ahead of time, the total property has 70,700 square feet. So that's how we'll know that we've entered in all the spaces correctly. So we have, how many spaces do we have? We have 2, 4, 6, 7 spaces here that we're going to enter in. So the first one is ground floor office. and that is 12,800 square feet. It's always available, and we're going to link it to the office leasing rule. We'll add our second unit, which is Suite 100, and that is 11,300 square feet, and always available, office leasing rule again. Suite 110, 4,500 square feet. We have Suite 200, which is 9,500 square feet. Suite 210, 5,300 square feet. Suite 220, which is 5,700 square feet. And finally, the top floor is Suite 300, and that is 21,600 square feet. And we can compare that to our total, and yeah, we have the same number, 70,700 square feet. So for each of these spaces, we can add a use. So the ground floor office has a special lease here, and this was a partnership with the university. And this is Catalyst Lab. And that tenancy started in 2015 on November 1st, and it goes all the way to 2040, the very end of the year, so last day of December. Once it expires, this will go back onto the market. At the time it was signed, it was leased for £72 per square foot per year, and it has an annual step increase of 2% of the base amount. And they got a full 1 year of free rent, but they were expected to pay recoveries during that time. There was no leasing commissions due on this one, but the landlord had to put in a fairly substantial tenant improvement of $120 per square foot. There is no incentives, and it's actually a gross lease, so there are no expense recoveries. And the payment will be monthly on the 1st. Okay, Suite 100 is another lease, and that is to Cam Biogen Limited. And that tenancy started in 2020 on June 1st. And it goes till 2028, the end of May. Once it's done, it'll go back to the market. The base rent is in pounds per square foot per year. That's 58.35. And there is no step rent in this case. There was some free rent. That was 4 months, and they had to pay their share of recoveries, or service charges as they're called in the UK. For leasing commissions, it was a percentage of the total lease value. That was 3%. The landlord contributed £75 per square foot. There was no incentives, but it was actually a full net lease with payment frequency monthly on the 1st. Suite 110 is currently vacant, so ReturnSuite will kind of reach into the office leasing rules and forecast a lease for this vacant space. For Suite 200, we do have a tenant here, and that's Kingsgate Accountancy. That tenancy started in 2025 February 15th, and that will go to 2032, the end of December. It'll go back to the market once that one is done. And in this case, the rent is £51,450 per month. So an amount per month. There is a step rent of 3% a year. So each year on the anniversary date of the lease, that base rent will increase 3%, and that will compound year after year. And the tenant got 7 months of free rent, but they were expected to pay recoveries during the free rent period. Again, a leasing commission of 3% of lease value. Tenant improvements were £590,000. No incentives, and it is a net gross lease. They pay rent on the first of each month. Suite 210 has a tenant, and it is Astro Nova Labs. Their tenancy started in 2023 at the beginning of September, and it goes to 2023, the end of August, and it'll go to the market when it's done. They are paying £5.15 per square foot per month. And they also have a 3% step increase each year. In terms of free rent, they got 6 months, and they had to pay, it didn't include recoveries, so they'll pay recoveries during their free rent period. The leasing commission again was 3%, and they didn't receive any tenant improvement allowances or incentives, and it is a full net lease with payment frequency monthly on the first. And finally, Suite 220 is vacant as well, and Suite 300 has been leased to Cambridge Advisory Group. And that lease started in 2015, 1st of July, and goes to 2027, the end of June. It goes to market when it expires. Their rent is an amount per year, and so in the first year it was £909,500 per year, and each year it increased by 3%. They received 12 months or a full year of free rent. They had to pay recoveries during their free rent period. Again, leasing commission of 3% of the total lease value. And they received £90 per square foot in tenant improvements, no incentives. It was a full net lease with monthly payments on the first. And so that is our entire rent roll. We'll save the changes. There we go. And we'll move on to vacancy and credit loss. Vacancy and credit loss are an allowance that's put into our NOI statement that account for either kind of vacant periods or just not getting paid by the tenant, so a credit loss. And in this case, we want to put in a 3% credit loss allowance, and that is going to be a percentage of gross income. So yeah, we basically, what we're saying is we don't know who's not going to pay us, but in any given month or quarter or year, kind of any given period, we kind of expect to not receive about 3%. We'll save those changes. Other revenues. So the only source of other revenues we have is parking. And that is an amount per year. So if we fully leased our parking lot, we would receive £202,400 per year. We're going to link that to market rent. Now, variability, this is how linked it is to the occupancy of our building. So if our building was completely empty, you wouldn't expect to get much parking revenue from your tenants. So in our case, it is actually 100% variable. So if our property was 75% leased in a month, or say over the year on average, we would receive 75% of this amount. And the payment frequency, so this £202,400, that's what we get each year if it's fully leased, our building's fully leased. But we actually don't charge annually, we charge monthly on the first of each month. And we expect that revenue to start and end for when we own the property, so property acquisition and property disposal. We'll save those changes and move on to operating expenses. So you'll see kind of the menu along here is actually the same as this drop-down menu here. Okay, we have 3 operating expenses. The first one is common area maintenance. And that is £8.70 per square foot per year. So amount per rentable area per year. We're going to link that to operating cost inflation. The variability, it is slightly dependent on our occupancy. So we're going to put that at 20%. So even if our building was completely vacant, we'd still expect to cover about 80% of this cost. And this is fully recoverable from our tenants that are on net leases. That is paid monthly on the first of each month, and the expense starts and ends as we own the property. Our second expense is utilities. This is, we have this as an amount per rentable area per year, and that is £5.85 per square foot per year. Again, we're going to link that to operating cost inflation. This is 100% recoverable. And in terms of variability, this is 40% variable. So 60% of this cost is fixed, and 40% is a function of the occupancy of our building. Payment frequency is semi-monthly. So when we do this, we're going to see our options change. We're going to see some alignment dates come up here. So the semi-monthly dates is going to be the 1st and the 15th. So that's already set up for us. And that'll start and stop as we own the property. And our final operating expense is insurance. And that is an amount per year. It is £83,750. We're going to link that to operating cost inflation again. It is completely fixed. The insurance company doesn't particularly care if our building is vacant or not. And this is fully recoverable. And the payment is actually done quarterly. And so what we do here is we're going to set a quarterly alignment date. So we'll pick one of the dates, and then the other 3 dates will be kind of determined by the system. They'll just be 1, 2, and 3 quarters after this date. And so our alignment date is going to be January 1st. So that works out well. And of course, just while we own the property. So there we go. We've entered in our 3 operating expenses. We'll save our changes here and move on to capital expenditures. And we have 3 CapEx items. The first one is an HVAC upgrade. And the amount is £450,000, and that's in today's dollars. But we're going to link it to construction inflation. And this HVAC upgrade is expected to happen on a specific date, and that's going to be June 1st, 2029. So this expense, the HVAC upgrade, will be £450,000 as of today, but this is going to be inflated over the next few years. And so when the expense actually happens, the expenditure actually happens in 2029, ReturnSuite will calculate that inflation into it. So we'll see that as tough to guess, but somewhere just shy of £500,000, I would assume. And that is not recoverable. The next capital expenditure is a facade and window replacement. And that is a little bit of a rolling project. So it's going to have a series of payments. Each one is £723,000, and it's going to be an amount per recurrence. So this ties the payment amount to the frequency. So however many payments we have, it's we'll kind of determine this down here, but each payment is going to be £723,000. We're going to link that to inflation. It is a fixed expense. It is not recoverable. And this is a payment that's going to be made monthly on the 15th. So each month on the 15th, £723,000 plus inflation. A payment of that size will be made. But it's only going to be for between specific dates. So this is going to be in 2027. And it's going to be April 1st. And the end date is also in 2027. And that is July 1st. So just to kind of map out here what's going on, kind of ignoring inflation for a few minutes, the £723,000 is going to be made every 15th of the month, beginning April 1st to July 1st of 2027. So what we'll see is on April 15th, the first payment will be made. May 15th, the second one. June 15th, the third one. And that's where they'll end, because July 15th is after the expenditure end date. So we expect to make 3 payments, April, May, June of 2027. And those will be for £723,000 plus construction inflation. And our final capital expenditure is an upgrade for Catalyst Labs. It is going to be a one-time reinvestment in the space for £1,280,000. We're going to link that to construction inflation. And that is going to be made in 2030 on June 1st. And it is not recoverable. So there we go. There are our capital expenditures. Save that and move on to purchase information. So the property was bought in 2022 on May the 12th. And it was purchased for £45,652,000. So that was the agreed upon price, but there was some closing costs. And so we have 3 closing costs. We have stamp duty, and that is a percentage on closing. In the UK, that is 5%. We had a broker fee, again a percentage on closing of 1.5%. And our third cost was legal costs. And it was an amount rather than a percentage, and that was £80,000. Okay, we can save those changes. Move on to financing. So when we bought the property, we used a purchase bond. And it's an amortizing loan for £21 million. And the interest rate is 5.25%. So that's the nominal interest rate. But it is actually compounding monthly. And you can see that means the effective annual rate is slightly higher at just under 5.38% per year. This financing started when we purchased the property. The payments are done monthly. The term of our loan is 15 years. And the amortization of our loan is 25 years. We'll save those changes and move on to the analysis period. So the analysis period is the window of time that we want to look at. So we want to look at starting the beginning of January 2025 and a 10-year analysis duration. So we want to look at the beginning of 2025 for the next 10 years. We'll save those changes and move on to reversion information. So this is if we were to sell the property at the end of that 10 years, at the end of our analysis period, what could we get for it? We have to decide what NOI period we want to capitalize. So we're going to use forward 12 months, which is the most common. But you can see that there's a series of options here. You know, off the top of our head, we don't know what the occupancy of the property is going to be at that point in time. So what we're going to do is we're going to put in a gross up percentage. So whatever occupancy the property has at that time, it's going to be adjusted to 95% of the occupancy. We aren't going to do any other NOI adjustments. And the capitalization rate on that NOI is going to be 5.25%. So we're assuming that we're going to achieve a 5.25% exit cap rate when we sell the property. And of course, there are going to be some costs or adjustments when we sell the property. The first one is going to be a broker fee. So that's a transaction cost. We're going to apply the amount to the adjusted reversionary value, not the initial reversionary value. So the adjusted reversionary value is after this gross up adjustment has been made. And the broker fees are 3.5%. And we're going to make an adjustment for stamp duty as well. That's a transaction cost. It's going to be, again, the percentage of the adjusted reversionary value. And it is 5%. We'll save those changes. And the last thing we're going to do is put in some assumptions for our investment return. We're going to say that, unlevered, our kind of cost of capital, what we'd like to make is 10%. And if you consider leverage, let's put that to 12%. We'll save those and we're done. So when we go back to the overview for the property, we should see a nicely populated overview. There we go. So we can see what our NOI is per quarter over the next 4 years. If we wanted to change that to, say, 10 years, we could do that. Here we go. There's our NOI over the next 10 years by quarter. We've completed our financial model, and what we'll do is spend the next video going through the different reports and see what kind of financial results our model is predicting.